What is it you think you're going to get? What is it you think you're going to be able to understand from this? Why would you be interested in the first place? Well, if I can show you today what we've done, if I can show you some of the information that we've been putting out, the question I suppose everybody must have is, can I use this to make money? When we started out talking about the retail space and what you guys understand about trading, it's back to front. The vast majority of people understand about trading is setups. Everybody understands the systematic setup because everybody sells systematic setups. Systematic setups, if you're in the world of institutional trading, systematic setups is like being the guy that takes an order from a phone. So somebody from the systematic setup picks up the phone and says, could you buy me 10 contracts? And your job as an order taker is to buy 10 contracts. You haven't made any decisions. You've not decided that you want to buy 10 because you're bullish. You're just filling an order for the systematic trade. The systematic trade is bullish, so you're going to buy 10 contracts. You don't know why. You don't know what the reason is. You don't know what's wrong with it if it goes wrong. And therefore, you're basically an order taker. You're not a trader. You're an order taker and an order filler. And if the system's good, that's not a bad thing. Let's not make any mistake about it. If the system's good, that is not a bad thing because that's actually a really good thing. There's no pressure on you to make any decisions. But this is why most people are here, because they've been order takers. They've bought courses. They've bought information that allows them to be order takers, that allows them to follow a process, a system that then doesn't work. And then what happens? They've not become a trader, and because they've not become a trader, they don't know why it doesn't work. They don't know how to fix it, and they don't know what to do next except buy the next order flow system, the next order processing system, the next systematic trade system, the next breakout trade system, the next mean reversion system, the next whatever. In other words, they're always order takers. The difference between the order taker and the professional trader is very simply, do you make the decision? So if you make the decision, then you're a trader. If you decide that you want to be bullish or bearish, you're a trader. But if somebody else, it's different if it's your system, because you've obviously built the rules. You know why it works and why it doesn't work, right? It's your system. But if somebody sells you a system that tells you what to do, you're not a trader. You're an order taker, and you're not therefore going to be, effectively, your entire success is now based upon the order developer coming up with the correct trade. Now, in a lot of cases, as I said, that can be very successful. So we have the usual type of idea that, at a certain trade at a certain time or a certain idea, we get this idea that we can sometimes see these types of trades and you say, right, well, if we get this type of trade here, then I want you to sell it. Well, that's an order taker, isn't it? There's no ability for you to say, no, thanks, I don't like it very much. You sell it and you either make money or you lose money. In other words, you're entirely dependent, 100% dependent on the ability for that system, whatever the system is, to call that trade correct. And if it's a positive expectancy, and it's not just back tested to be a positive expectancy, because otherwise, why would they have brought it to the sales floor in the first place? So if it's got a positive expectancy on the right-hand side going forward, then of course that's a good thing. But it still doesn't make you a trader. It makes you an order taker, because the system's giving you the order, and all you're doing is executing the order for the system. It says sell it here, you've just sold it here. Did you make the decision? No, the system made the decision. Somebody else's system made the decision, and they're using your money to play with. That doesn't sound like a great deal, does it? As I said, if the system has a positive expectancy and you've proven that to yourself, But obviously the point is that if you're here, there's a very good chance that that might not be the case. Or maybe you do have a nice positive expectancy system, but you want to develop out your ideas of what a trader is, because at the moment you simply don't know what a trader is. So you want to become a trader so that you can start perhaps interacting with this system for yourself. We've got a positive expectancy system. We've had 2 trades from it today on a 5-minute S&P chart. There was a sell, there was a buy potentially, and there was another sell. So we got 3 trades, but basically the idea is, depending upon which side we go on, the positive expectancy comes from this little process here. If I tell you you should be trading the blue candles, so when we get a blue candle here, the idea there is it's gone into a red zone. So if I get a blue candle and it's gone into a red zone, that's an automatic sell trade. And if that's an automatic sell trade at 45.10s, it traded a low price of 45.03s for 7 points. Now that's an automatic sell trade that every intern in the world would obviously understand. It's basically just a momentum trade. And then we've got a blue candle when the market goes blue here, a light blue candle when the market goes blue. According to the process, that would be an automatic buy trade because it's turned the market blue at that stage. That would be an automatic buy trade. And that was a buy trade at 45.14s, and it traded a high price of 45.30s for $800 profit, maximum swing, of course, maximum swing. The hard stop on those trades would simply be to put the stop below here, which would have meant, for example, that on this trade here, you could have looked at that and says, well, how many times risk was that in terms of return? And you could obviously do some calculations for yourself. So if that's the amount of risk you're using, you can obviously now look at this and say, well, that's 1, 2, 3. That's a maximum of 4 times return on my money. And this trade here was a maximum of about 2 times return on my money. So that would be 6 times return on your money using a 2% risk. That would have meant that on those 2 trades, you're up 12% on the day so far. If you were able to hold the full swing, of course. You can see here, for example, the market went red and we had a blue candle. Now, interestingly enough, that wouldn't have been red at the time, nor would it have been blue at the time. It would only have went red on this candle here. So this was the only sell trade. That's why I said there's only 3 sells. That would have been your sell trade. And obviously, if that was your sell trade using a systematic set of rules, we can recognize the stop process. We can recognize the risk-reward ratio process here as well. If you're doing it from the close or the low of the candle, makes no difference. But obviously, if that's where your sell price is, you can see that that would have done 1, 2, 3, 4, 5, 6, nearly 7 times your risk. Nearly 7 times. If that was 6 times your risk, and this is another 7 times your risk, that would have been 13 times your risk. 2% risk, that's a 26% maximum return on the day on 3 trades. But the point is, what we teach is why that's a trade. Why you wouldn't take the sell trade on certain occasions and why you would take the sell trade on certain occasions. Why do we need a systematic trade though? If we teach trading, why do we need a systematic trade? Because it's always nice to be able to step back into something when you lose your way. In other words, if I am not sure, then this is a sell trade. If I'm not sure, then this is a sell trade. If I'm not sure, then this is a buy trade. So unless I have proof to the other side of this deal, then I can go ahead and stay with the systematic trade process. I can understand the systematic trade process and I can lean against it because it has a positive expectancy. When we look at this positive expectancy and we look back at some of these other trades, we can see this is the London session. This is the overnight session. We can see the market was red here. We started to see that same blue combination of candles. And because the market had been red here, we could actually have gone short here. And you can see that we got a very, very nice short sell coming in. The market was red at the time. Because the market had been red over here, we can actually recognize that that is not a buy trade, but this is a sell trade. Now, as you learn things, you can actually fade some of these trades, but that's a different trade altogether. When we start learning this idea, we can recognize that the market has been red for some time, in fact, but we never got any systematic trades here. Take a look at this trade here. You can see here, for example, that the market had obviously gone red, but then it cancelled the red out, and we're obviously left looking at this and saying, is it still red? Well, we can see that in the background, this market had been red here, so we got another systematic sell trade here. We got another systematic sell trade there at that stage, and obviously we're now building a new systematic trade reference here. This one wasn't, and we'd obviously explain why, and obviously from that point onwards, the systematic trade we would have been down here, because we would have started to re-establish the fact that we were now in the same type of marketplace. Systematic trading is the way that you start to understand this. The market's been red here, so you can see the sell trades. Now, you got a little bit unlucky in that one, because if you were using a full one-time risk, you got a one-time loss on that trade, didn't you? So there was one trade where you would have taken a 1 hour loss on that deal. You may even have taken a 1 hour loss on that deal. So that's a 2 hour loss you've just had. Now, you wouldn't have taken this deal because obviously it's now going into higher prices. These are called momentum trades. So obviously the 2 hour loss you've had at that stage, you make back on this trade here, and you more than double on this trade here. The idea is not to make it back, of course. The idea is just to keep trading the systematic trades. So systematic trades don't make you a trader. They make you an order taker. So you're basically just filling the orders according to the order requirements from the rules. So you learn the rules, and if you're struggling, you can go back to the rules. We teach that. But we don't stop there. What we teach is for you to become a professional trader, not a rule follower, not an order taker, not one of the guys that gets paid a wage, a guy that earns his money by taking a commission off of their trading abilities, a guy that makes the big money instead of a guy that gets a basic wage. So when you start understanding the difference, we start understanding the big difference. We start understanding the kind of trades that we can take. Let's show you a couple of examples. A lot of people come into these types of things and they think, okay, dead skeptical. Is there any proof? Well, if you assume that Twitter is honest, as in the timestamps on Twitter, and it's not photoshopped, and you can always challenge us on that one. The guys can tell you that are on the Twitter. They can tell you whether these are true or not. But these are the trades that we had this morning, just to give you an example. This is the London session. All times are London times, by the way. And you can see that we had this little tweet here. And this is actually on the UK gilts market. It's at 9:20 in the morning, London time, 9:20. The upright is when the time came in. This is when the tweet was sent out. And what I've said here is that I'm shorting top lines at the moment. So what I'm basically saying is be alert for a top line sell. Shortly afterwards, in fact, around about 20 minutes later, the price runs the top edge, and we've not changed the narrative at this stage. It's still a sell at top edges, still a sell. So we send the tweets out to show you what we're doing, to alert you to the fact that this is what the deal is for the morning. As a trader, not an order taker. As a trader, you're now able to go into your gilts market or your bond market, and you're able to now look at that trade and assess for yourself if you think that's a good short when it retests up here. And if you think that's a good short when it retests here, because we've told you a little bit of information there that you can now take to your charts and say an hour later or 50 minutes later or 20 minutes later, in this case, 30 minutes later, a second trade appears at a top edge. And we get a little sell, which ultimately moved. And at the time of the screenshot, it went for $300 profit, £300 profit per contract. Not a big winning trade, but still £300. If you had that information and you knew how to read that information, do you think that knowing this would have made you money? As an order taker, no, because it doesn't tell you to buy it or sell it. It just says, I've got a short sell from a top line. As a trader, this is invaluable information to say, right, the bank is selling gilts. What price did the last sell trade come in gilts. It came in at the top line there of 95.10. So they went offered at 10, and that's held the market offered really nicely down to 94. So if we come back up to the 10s, I can take a look at this myself, because the top of the desk is selling gilts. As a trader, not an order taker, you've then got the ability to come into that trade if you want to and make yourself ultimately £300 over the course of the next, well, you can see the last trade there was only around about 12 minutes, 13 minutes. It goes from 95.14s down to 94.84s for 30 points. 30 points at £10 a point. £10 a point is £300. So around about, you know, you're obviously looking at a very, very nice trade. Around about a $360 profit per contract on that trade 10 minutes later. So was it just once in the London session that we came up with something interesting? Well, what about the trade that happened maybe about an hour later? Let's take a look at the trade that happened an hour later. Cable. The top lines look vulnerable now. So watching if we sweep the 2480s to the 25 handle. So what we're seeing there as part of this underlying complex, and remember the tweet comes out here at 10.04, which is 10.03 candle, before the price breaks north out of this level. You can see I've marked off the 2480 to the 25 area. So I'm looking at that 2480 to 25 area for a short sell. You can see that the sell then comes in after the tweet, not before the tweet. The sell comes in a few minutes after the tweet sent out. As a trader, you can now look at that and say, I agree with this trade. I understand the reason for the trade existing, and I can now recognize the opportunity. I can now recognize the opportunity perhaps from order flow. I can recognize the opportunity perhaps from price action, but I can recognize the opportunity. I am going to take the sell trade. I'm going to take the sell trade. That means you're a trader, not an order taker. So all of a sudden the sell trade comes in at 85s and we drop down to 70s for 15 pips. And we get a very nice outcome. Another very nice outcome. You can't lose money on those types of trades, can you? It looks absolutely fantastic. So is that where we stopped? No, let's move on. In fact, we moved backwards 10 minutes. They're out of order, guys. That's okay. So we move back 10 minutes. Take a look at this trade here for a second. You wouldn't imagine that this was possible in the retail space, but take a look at it anyway. We've got a global macro PF hedger trade. Not exactly order taking stuff here, is it? It's not exactly if it breaks out of the 8 o'clock box, take a buy trade. If it goes above or if it goes below, take a sell trade. It's not exactly that type of quality of stuff here, is it? We're talking about the global macro funds. We're talking about the pension funds. And we're talking about the hedgers. Into these highs, we're going to sell the S&P and we're going to buy the FTSE. And we buy the FTSE 3-to-1 ratio because of the nominal value of the two products. We use a 3-to-1 ratio and we buy the FTSE and we sell the S&P according to that instruction at 9.49. Take a look at the uprights when we did this chart here, 9.49, 9.49. No funny business going on, right? We sold the S&P, it's got a down arrow. We bought the FTSE, it's got an up arrow. And you can see that over a period of time when we closed out this trade, the S&P position lost $175. The long FTSE position made a profit of $485. So in other words, we made a profit of $300 from a hedge trade. Just think about what we got in that trade. We got a equity neutral position, didn't we? Our nominal exposure to equity markets was zero, pretty much. We were short an S&P position and we were long a FTSE position. Our exposure to equities was therefore zero. So what makes this a deal? Is that not an interesting idea? What makes this a deal? We've made thousands in this today. This has been a great day because we focused our attentions in the London session actually on this one subject. We said that we would cover this today in classroom so that people could understand the process better. Does this sound more like trading, or does this sound like order taking? Does this sound more like a professional trade desk, or does it sound more like somebody telling you if it breaks this 8 o'clock box, you should be a buyer or a seller? I've mentioned before, Kim says some of these systematic trades can be very good, and I 100% agree. She says, you'll make sure people understand that they can be very good. They can be. We've just shown you a systematic trade that is very good. But a systematic trade doesn't make you a trader, it makes you an order filler. It makes you an execution trader. You're only executing for somebody else. You're executing for somebody else's rules. And therefore, what is the problem with that? The problem with that is you're only as good as that other person is. You're only as good as their rules are. You're not as good as you are. Would you not like to be in control of that for a change? Would you not like to be as good as you can be, not as good as somebody's rules are? Is that not something that appeals to everybody? Personally, I think it should. Maybe it doesn't. Maybe I'm the exception rather than the rule. It seems to me in the retail space, a lot of people simply don't want to be the one that is successful or not. They want somebody else to do it for them. Well, that doesn't make you a trader. That makes you an execution, and you're always relying on the person that is making those decisions for you. I don't want that, guys. I want the career. I want the opportunity to be in charge of my own destiny, not somebody else. And if that's what you've always been looking for in the trading space, this might be the only place that you'll find it. Everybody else, almost without exception, and I'm sure there is a few exceptions, will give you a set of trading rules. We do that as well. But we don't just give you rules, we give you an ability to countermand those rules. We give you an ability to say, nope, I don't like this one very much. We just showed you an example live this morning or this afternoon, just the one we've just shown you there on the S&P. We could easily have just bought that S&P. Instead, we shouted it out before it happened. If this goes 20 offered, I think it was. If this goes 20 offered, just let it go. It's not going to stop until we hit that measure move. It went 20 offered. It all went all the way down to 8s. Exactly as we said it would. Exactly as we said it would, suggested it would. So as an order taker, you'd have probably been a buy trade there and you'd have lost money. And you say, okay, so what would the person tell you to do? Write it down as a losing trade and move on to the next order, correct? And you go, okay, fair enough. With a positive expectancy, that doesn't make any difference because you've still got a positive expectancy. And I can 100% agree with that. But do you not want to be the trader just once that says that trade isn't going to work? I don't care what your rule tells me. That trade right there on this occasion is not going to work. And therefore get rid of the bad trades out of that process. Get rid of the duds. Get rid of the ones that aren't going to work. For a change, you take charge. For a change, and there are a lot of retail traders don't like taking charge because now they're responsible for their outcomes. The retail trading world is dominated by moaners and gripers. They want somebody else to blame for their lack of success. They want somebody else to blame for why it's not working. Well, it's not working because you're buying into processes rather than taking the responsibility for yourself. And for some people, they're happy with that. For some people, they want to be able to blame somebody else for their lack of progress as a trader. The only person you can blame for your lack of progress as a trader is ultimately therefore yourself, because you are the trader. You're responsible. You are the system. You don't follow a system. You become the system. You are the reason why you make money. You are the reason. You can't ever lose that. It doesn't matter whether the market changes. It doesn't matter what market you move into. You are now a professional trader. You're now the reason for your own success. The market can throw all sorts of things at you and you still end up coming out on top because you have the ability as a professional trader to change the rule. to bend the rule when it needs to be bent. How many times, if you've tried to follow rules from somebody else, have you looked at it and says, I just don't like this trade, but hey, the rule says take it, I've got to take it. And it doesn't work out, and you say, damn it, I knew it wasn't going to work out. And then you'll hear from the seller, but that's part of the process, and it is absolutely part of the process. It's a systematic rule. The reason it's there is to stop you having to make a decision. That's the point of a systematic rule. It stops you having to make a decision. But we give you that. But we give you the ability in due course to make the decision, which is why this class is called Intern to Pro. We give you the rules to start following, and then we give you the ability to start countermanding those very rules that we give you. Now, that's a little bit unusual, right? So when we think about the difference between the Intern to Pro process, this is what we were talking about this morning. When we talk about the Intern to Pro, the difference is all in this here. The intern process is seeing it happen. In other words, getting an order and seeing what happens with that order. The pro process is predicting it's going to happen. It's predicting what's going to happen next. The intern's process, in most cases, and you can disagree with me, because in most cases, it's reacting to something happening. It's reacting to information, isn't it? So for some people, it might be, for example, a breakout of a box. Okay, draw a box here. If it breaks to the sell side, sell it. Draw a box here. If it breaks north, I want you to buy it one tick above the box. In other words, you are reacting to the information. You haven't got the ability as a trader. So the questions will always come up. What happens if it goes up 3 ticks and then it starts coming back down? What do I do? And the person that's on that process will give you a clean answer, which is absolutely true and honest. They'll say, well, you just let it go. You either get stopped out or you make your target. What happens if I get stopped out? Nothing. You take the loss and you move on to the next trade. Fabulous. You're an order taker. So what you're looking at is you're looking at a systematic process that genuinely makes money, and that's, as I said, nothing wrong with that. But just don't think you've become a trader at that stage, because you haven't. You don't make the decisions. You make no decisions. You just follow a rule. So what you're doing is you're basically taking the order from somebody else, the designer of the system, and you're putting that order flow into the marketplace. And you're getting paid if that system makes any money. And if it makes money, good. You will feel very good with yourself. But what if it doesn't make any money? What if it used to make money and now it doesn't? What are you going to do? Do you just stay with the system until you get broke? Do you stay with the system until it, you blow up another account? Do you stay with the system until it comes good again? Or do you say, I wish I had a way of figuring this out for myself? So we obviously look at this. The reacting to information can come from many different ways. A lot of the times it could be data. So you could look at data, for example. We could look at the data and we could say, well, if the data is bullish by X percentage, I want you to buy it. If the data is bearish by X percentage, I want you to sell it. So you could get a reaction from the data. You're still following somebody else's rule. What happens if it's bearish and the first thing that happens is somebody buys against that bearish data? What do I do now? Absolutely no idea, because unless it's in the rule, I don't know. You've just got to leave it till your stop gets hit. Do I not want to interact with that? Do I not want to step into that market and say what? Of course you do, but the rule doesn't allow you to do it, so you've got to stick with the structure. And then, of course, you've got those structural trades, the breakout trades, those kind of ideas. So you'll get these types of trades. And as I said, there's nothing wrong with any of these, but they don't make you traders. They make you order takers, and if the order system is good, it's good. Carry on. Be my guest. I mean, it'd be brilliant. They will just take somebody else's orders, but it doesn't make you a trader. What makes you a trader is the ability to make that decision in the first place. And obviously some of these reactions are based around volumes. So you see a volume candle and you say, well, depending upon what happens to that volume candle, that makes me a buyer or a seller. But what if you could predict the volume candle? What if you knew it was going to be there all along? Could you not have been the guy that was on the volume? Could you not be the volume? In other words, you start to become a professional when you become the data, when you become the structure, when you become the volume. So when we go into the professional side, you can't go to the professional side until you understand this part. This is the intern part. So the intern part is very much part of this logic. The intern part is very much of this type of process here. Okay, if it breaks the low here, I want you to sell it. And the intern has to sell it. The intern has to sell it because that's the system. And what the intern starts saying after a bit of time is they start recognizing that some of these trades here work beautifully. And some of the time they recognize that these trades do the same thing. You must sell it, you must sell it. And some of the time the trades do that. And they say, but I knew that trade was going to do that because of this. I knew that trade was going to do that because I understand this. Well, what's happening to them? They're moving from an order taker to a professional, aren't they? They're moving from intern to pro. They're now looking at this and saying, I like that sell trade. And they're looking at this trade and saying, I like that buy trade, but the rule is still the same. The order that came in was still to sell this. The reaction to the order is what made them a professional trader because they wanted to sell this one in line with the rule and they wanted to buy this against the rule. What made them have that ability? It's obviously not the rule. The rule was to sell it and that didn't change. The rule was to be short and that didn't change. So what was different? It was the knowledge base about what this was going to do next. It was the knowledge base that told them, look, I know what the rule says, but in this occasion, I want you to buy the break instead of selling it. That's the difference between an intern, inverted commas, an order taker, inverted commas, a systematic trader who follows a rule that's not their own, versus a professional trader who now is the guy that's predicting what's going to happen next. Did this intern predict what was going to happen next by selling this one and buying this one? Did they predict what was going to happen next? Yes, they did. Did they have the same rule? Yes, they did. Did they have the same sell order? Yes, they did. And on this sell order that came in from somebody else, because remember, you're now the professional, when this sell order came in from somebody else, you sold with them. When this sell order came in from somebody else, you bought it from them and you put it on your book. Same sell order, different response. This is the difference. The professional trader has to now develop out this idea of the unknowns. The professional figures out what the unknown is against a certain probability. Does this buy trade have a probability that I can work with? Does this buy trade have an outcome that I can actually look at and say, on average, I'm pretty good at this? But here's the point we came back to at the beginning. If you're not very good at that, that's going to take time. You're going to take a bit of time to learn this process, the professional process, the trading process. But until you learn the professional trading process of which orders to agree with and which orders to negate, you've still got the intern, you've still got the order process. You've still got the ability to say, well, unless I know otherwise, I'm still going to sell it. Unless I know otherwise, I'm going to make the best job of this short sale that I can possibly make. And what we do with that is we start learning other trades. So if we go back to this trade here and you're not quite sure about your professionalism at this stage, and you start seeing the price dropping, instead of selling the breakout, you get the ability to come in a little bit before the break. In other words, you're developing your ability to improve on your order processing. It's all about the execution now. You're not determining whether the order's right. You're not, for yourself, looking at it saying, I know that the order's wrong and therefore I'm going to buy from the seller. You're simply still selling it. And then you're reacting to whether the order's right or not, because when the price then breaks, you either get this trade here, which then obviously continues beautifully and you make a lot of money, or you get this trade here, which obviously then scratches you out for a scratch trade. So in other words, you react to how the price then develops. You're not deciding, you're reacting. So you stay on the systematic trade whilst you learn the professional trade. Does that make sense? So as you learn the professional trade, you start to recognize how this trade can start working for you. You start recognizing some of these trade outcomes. You start recognizing some of the rules associated with this trade. Now, obviously, if you look at that systematic trade there, and we obviously look at that and we says, right, we're going short on this break here. You've got the ability to say, well, the break obviously was the prior low there. So we had a prior low just in the background there. So the systems trade would be to be short the break of the system, right? To be short the break here. What we are saying is there must be a way of being able to get into that break earlier. And we could get into that break earlier, couldn't we? And obviously, if we get into that break earlier, we might go again into that trade there. We say it's still the same trade. It's still the same idea. I'm going to try and make my money on this. But there's also a way of us looking at that and saying, do I want to take the sell in due course? And we learn this. But if you don't learn it, or if you don't have any other ideas, you simply take the sell and you still make your money for the evening. You still make your money for the UK session here. And you can see that if we sold off of this, we already tell people the hard stop should be here. If you take any of these trades, that's where your hard stop is. So if you were looking at that as a hard stop trade, the actual systems rule, actually, to be perfectly honest, the systems rule that we tell people is to sell it at that price there. See the bottom of that orange box? That's actually your sell order. So for the systems trade, for the guys that don't yet know how to be professional traders, the systems trade would be to sell there at 22 and a quarter. Their hard stop would have been here at 28 and a half. 6 points higher. It's a 6-point trade. Okay, so it's 6 points. It's $300 or $30 in your micros. But you can see that from that trade, you could say, well, what's your risk reward? We're going to go for 1, 2, and 3. Our risk reward, we're going to go for 1, 2, and 3. So you can now recognize that we get 1, we get 2. We don't quite make it to 3. So maybe you get 2 and you get 1 again. So you get 2, 3, maybe 4 points profit on that trade. 4 points profit, 3-point risk, because there was 3 contracts. Well, that's okay, isn't it? So 4 points profit would be 3% if you're using a 2% risk. 7.5% if you're using 5% risk on the 3 trades total. So obviously that's a systematic trade outcome, isn't it? So with that systematic trade outcome, you'd obviously develop out a set of rules when to move the stops at break even. You'd have a set of rules about how to take profits. You'd have a set of rules, etc. But as you develop out through the class, you start to learn whether you wanted to take this trade in the first place, or whether you wanted to buy these blue candles instead of sell them. How far you wanted to take the price. How long did you want to hold the trade on for? How we can make a better job of maximizing the trade swings. As a professional trader, you start interacting with that intern process, that intern logic, that intern ability. Not to the point where you replace it, but to the point where you complement it. And the reason why that's important is because if you lose your way as a professional trader, you can still fall back on the intern's exercise. You can still fall back on the intern's trade. Look, if the background is red, I just want to be selling it. I just want to look for sales. I want to find good sell opportunities. You can chuck a stochastic on a red background here and you'd still find great trades, right? So it doesn't matter because you're still being able to fall back on something. When you look at the big picture of this, and I ask you for the ability to be trading this as a trader, can we all agree that when the market's blue, you could have made a lot of money simply by being long? You see how it's blue here? And it stays blue right through that entire process? Well, guys, it went blue at 12s, and it stayed blue to 38s. Can you see when the market went red, it stayed red through that entire process there? And you could have obviously have went from 32s back down to around about 4s. By understanding these processes, you can still make money even if you just follow the rules. The ability, however, to improve on the rules, the ability to discard the rules, and in fact, trade opposite the rules, is when you start learning to be a professional. And when you learn to be a professional, you start taking trades like the ones we just showed you. You start taking trades like some of these ideas that we've just put on the screens. Let's take a look at the S&P for this afternoon. These are all tweets based on the professional trading process. You can see the market is dominated by the blue side. So by rates, we should be buying for the press into the top edge. By rates, we should be buying for the press into the top edge every time we see a dark blue candle reversing, right? So we saw a dark blue candle reversing there. We should be buying for the top edge. We did get the top edge. We bought for the top edge and made money. So if you didn't know, you could still make money there. We get a blue candle there that reverses. We could buy for the top edge and we got a little pop to the upside. We might have scratched that. We got a blue candle there. We never got a buy trade. We got a blue candle there. We got a buy trade. Top edge, sure. Made some more money. Blue candle, reversal, buy for the top edge, sure. Made some more money. Blue candle reversal, no. Blue candle reversal, yes. Blue candle buy trade there, top edge, made some more money. No trade here. Sorry, yep, there was a trade here. That was a loser. That was your only losing trade right there. But you wouldn't have taken that trade. Why? Because we're coming into a new decision. The new decision is these gray areas. A new decision is these gray areas. So you wouldn't have taken that decision there because it's in a decision area. There's a new decision coming. And in that case there, we'd have obviously been looking at the probability now of selling this because the market had gone red. And that led to that sell that ended up way down here. So that's the interns trades, following the rules. The interns trade of following the rules would still have given you a winning trade here, 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 and no trade here, and possibly a winning trade here. So in other words, you'd have had 100% winners over that period between 1630 and 1930 for 3 hours. Perfect. A nice set of rules, an easy set of rules, an understandable stop, a clean, easy stop to put on your charts, an ability to calculate target prices, an ability to see these. And as you're learning these processes and as you're understanding this idea, you're learning when to say no. You're learning when to say, you know what, I think that's absolute bollocks, that trade. I know, therefore, what they're doing. I think this is a sell trade. You still know what the rule is. And you'll start to be able to determine whether you're any good at figuring this out or not. You saw from my idea here is, in the early stages at 4 o'clock, which is at the beginning of the left-hand side of this chart, I still said at that stage the short term was still constructive. So I think we're going to keep testing the highs. That's the professional opinion. We started to see a big absorption buyer at 550 on the NASDAQ, for example. So we were starting to recognize that this was still bullish. We should still keep testing highs. Well, guess what? From 4 o'clock, we kept testing highs. We can all agree that that then happened. So therefore, taking the interns buy trade here or the interns buy trade there, that seemed to still make perfect sense at that stage. Taking the bottom edge reversal here still seemed to make a lot of sense because we're still short-term constructive bullish. As we came into 553, now where is 553 on the charts? Well, we'll make a guess about it. 45, 46, 47, 48, 49, 50, 51, 52, 53. So at this point here, 553 London, the macro bears are still in play, and we discussed that in the room. not on the tweet. So I can't show you a tweet. It was a room call. The macro bears are still out. So the micro bulls will run top lines. Did that trade happen? Yes, it did. So with the micro bulls still running top lines, you could still have had that buy trade. But now, because of your professional trade ideas, you're now able to sell top lines as well. So you're trading for the run of the top line, but now you're trading for the macro short sell. And down the price went, and it dropped really hard. We had a conversation about it. So you'd have been able to take advantage of that macro bear with the micro bull. The gamma building on the short side now, which means that the market's going to get slippy. Everybody understands that, yes? As the gamma builds on the underside of the market, if you start breaking levels, like bottom edges, you get an awful lot of hedge flow coming in to sell into this to hedge out exposures. So when you hear the phrase that gamma's building on the short side, you start looking out below because this is going to get slippy. That's not an intern comment. That's not an order taker's comment. That's a professional trader's comment that you would start to understand and you would start making for yourself. I can see that gamma's getting slippy on the short side. That reminds me not to be too mad about buying bottom edges because it could slip clean through this. If I see any evidence of that slip through this, I want to get out of the way fast and I want to flip it for a short sell for the press, for the squeeze. That's a professional's comment. And for those that came in early, for those that were lucky enough to hear that commentary before we got started today, that is exactly what we said. We says we're not going to buy this one at 20 because I think it's going to get slippy and it's going to break south. It dropped from 20 to 0.6. That was a live room call, not hindsight. For a lot of people that think a lot of this type of stuff is all hindsight, you all saw that that was a live on the right-hand edge in this room tonight, a live trade call that could have made you potentially $700 per contract. So if you just followed these trades, you've already paid for the course on a 2-lot. These trades alone would have covered the entire course fee on a 2-lot basis. One of these trades could have potentially done that. That sell trade could have potentially done that as well, nearly. You're already getting this idea that it's not going to take long if you follow the process, even the intern's process, that this is going to work out as a positive outcome for a change. And one would imagine that you're here because you haven't had that positive outcome yet in your trading. If you have, then good on you. I don't know why you're here, but that's good. That's a good thing. I would be delighted for everybody if they could make positive outcomes. So when we start understanding this, you might say, well, what else? You know, we've seen a couple of trades. You said you'd taken some screenshots of some of the trades from yesterday. Let's take a look at some of them. So this is yesterday. You can see that these are all trade stamped. You can see the wording is exactly the same. I've taken the main triggers, which is these max strong bids and offers, and some of the other ones that have combinations of bids and offers, and I've numbered them. This is the 12th of September, so that's yesterday, as you know. So this was a screenshot so that you could see what an early part of the day would have shown you. And you can see that on trade number 1, we had a strong bid coming in from the dispersion hedge activity at 14.32. Trade number 1 at 14.32, there it is there. You can see that you would have had a very, very nice outcome from 22s, 21s, up to a high price of 32s. That trade on its own would have been worth $500 a contract. If you saw that trigger, do you think you would have had the ability to trade it? Do you think you'd have had the ability to either buy the pullback on this pin or simply buy when the price broke north out of here? Do you have the tools? Have you got the ability to start developing the pro skills that are needed to take this trade on? If you don't yet have those skills, this is what we're going to teach you. If you've got those skills, you can almost walk in here and straight away you're making $500. Let's take a look at trade number 2. What was it about trade 2 that gave you an opportunity. So read the narrative, and you tell me if you think you could have made money if you saw that. Trade number 2 at 14.42. You can check the times for yourself. We get another one of our strong max trades. Max strong bids. It's not one of the average trades. If it's an average trade, we need to build a picture. When we get these max trades, we're trying to get into it as rapidly as we can from a good liquidity point of view. The point I'm asking you here, guys, is if you saw that, which is now given to you as part of this class, if you saw that, would you be able to make money from that trade at 14.42? There's the trade there. You can see the timing on the screens. 14.42 came in here. So when you know you're going to try and run the liquidity, can you all draw a straight line from that previous level because it's a pivot price? Do you all know that that's the liquidity you're looking for? If you know that that's the liquidity you're looking for, you could obviously, you might have bought this candle first of all, and you would have been able to make some money in scratch. And then secondly, you could certainly have bought the 26s here and taken the market back up for 5 points. Worst case scenario, that's another $250 potential on trade number 2. Let's take a look at trade number 3. This is a series of messages over 3 minutes. You tell me if you think you can understand them. You tell me if you think you could make money by using them. Futures offers, futures offers, futures offers, futures offers, futures offers. A sell program, which is a momentum sell program, which means you sell this one on the way down. If you're not selling it on the way up, you can sell it on the way down because it's got momentum in it. And another futures offer. Trade number 3 is, of course, a sell trade. It starts at 14.55 through 14.58. Could you have made money between 14.55, which is the middle of this box, and 1500 hours? Could you have made money selling on the way back down again? You could have made money by selling on the way up, but we never ran top edges. That's why we sold on the way back down here. And could you have made money? Another 5 points. That's another $250, guys. Do you realize that between 2:30 and 3 o'clock, well, let's take it to 3:10, that's a 40-minute period between trade 1, 2, and 3, that between those 3 trades, you could have made $1,000 per contract. 2 contracts, you could have done $2,000. This is assuming you think you could have followed those rules, followed those trades, came up with an idea that you'd be developing yourself to become a trader. And ultimately, you would be deciding whether you agree with the trade or not, because at the end of the day, some of these trades are spread trades. So you've got to still have the ability when you get to become a professional to say, I'm not going to take that trade. I don't like it. Some of the guys in the room say that already. We've got some of the guys in the room that are already calling buy trades on pound, for example. Jerome called a brilliant buy trade on the pound this morning based on these rules. The buy trade made money. I don't know how long Jerome's been in the room, but it was a great call. It was a live call, and it was in advance of the level even happening. It was in advance of the trade taking place. It wasn't a reaction to something. It was a forecast about something that was about to take place. Let's take a look at trade number 4. Trade number 4 is basically just over a 1-minute period. Futures offers, and 2 momentum sell programs. This looks like a trade that we're going to be selling on the way back down. Does everybody know how to sell a candle reversal? Congratulations, you've just learned the rules. You're going to be looking for a candle reversal to sell this. So when we look at what happened on trade number 4, can you see that we actually put the line on the candle reversal? And what happened? We got one surge to the downside, never took out the top edge stops, which were only 1 point away. And then we got a very big swing from 29s to a low price of 19s even. It's another $500. Let's just get this straight. In the first 4 trades of yesterday, you've now seen trades worth $1,500 per contract, $3,000 on a 2-lot in the first hour of yesterday's business. We're not saying you would take them all. We're not saying you would agree with them all. We're not saying that these are all trades that this is what you would do in terms of the outcomes, because everybody's got their own ideas about target prices. Everybody's got their own ideas about risk. But if you simply start even thinking about the rule set, imagine you just says, right, I'm going to take 1 and I'm going to take 2 and I'm going to hold it until I get 3. And then I'm going to add it 4, and you get down into the bottom edge and you say, right, that's enough for me. I've just made $3,000 a contract. I've done, $3,000 on a 2-lot. I've done $1,500 a contract. I've done $150 on my micro account. It's not going to take me long to be trading on the big account. We're not asking you to believe us. We're asking you whether, if you use this information, do you believe that you could make money? Do you believe if you saw that information there that you could have made that decision? Do you believe that you've got the abilities even now, without learning anything else, to look at that and say, I've got a fair idea what to do here? Well, it can only get better from that information, can't it? Now we can start adding to that information. Now we can start saying, well, now you've got the ability to countermand some of those ideas. Now you've got the ability to time some of these ideas. We had a sell trade on oil, for example, a buy trade on oil. We bought oil at 40. And I was live in the room at the time, and I said, right, we're buying oil at 40. We got to 50. And I gave a very, very clear shout, even though everybody was still thinking bullish, because of what the order flow was telling us at that point, which has got nothing to do with the buy trade rule. The buy trade rule said that we should probably still be able to go for another 20 or 30 ticks, right? But because of what we were seeing elsewhere, we told everybody it's not going to go above 50. And if it does, it'll be a sell trade. Guess what happened? The oil sold off for nearly $1,000 from the 50. So the buy rule was saying stay with the trade. We were in at 40. The buy rule was saying go long, stay with the 40s, and then you'd have scratched out at 40 because it never went through the 50. The professional trader says get the trade off at 50 because it's not going to go through it, guys. And we made 10 ticks instead of losing money or scratching. The professional trader, which is also what we teach, is why we go from intern to pro. You've got the rules that gets you into the trade, but you've also got the rules and the ability and the training to say, I don't like it anymore. These rules would have enabled you to be a buyer into yesterday's 10-year bond auction. These rules, we covered in today's classroom, would have allowed you to sell into today's oil inventory release. Oh, yes. These rules would have allowed you to do all of those decisions in advance of the right-hand edge happening. We call them the exi trades or the execution trades. And everybody in the room currently are learning this process. In other words, they're learning to become more responsive to what's happening inside the auction. This doesn't sound like a retail class, does it? It doesn't sound like it's something you should learn in a retail class. This sounds very, very different indeed, I hope, anyway. So let's see if you still agree that this is something that can make you money. Let's take a look at something else. Sorry, we've got one more trade to look at. I think this might be the last trade on the S&P. This is a series of trades, and this is trade number 5. Look, it starts at 15.59 and it goes on for 20 minutes. We've got a buy program, okay? So that's a momentum buy program. We've got a futures bid. We've got a market maker adding bids below. That's pretty obvious. Below what? Below the prior low, right? We've got an option dispersion bidder coming in, right? Bid into. And we've got market makers adding bids a second time, 20 minutes later. So you can see trade 5 looks like a big buy trade, correct? It looks like something every single one of you would be looking at it and saying, I've got a lot of ability here. I can see some of these trades. I've got some order flow I can play with. I've got a book buyer showing up. I like this. I like this area. I'm going to join this as a buy trade. Let's see what happened to trade 5. This is what happened to trade 5 over that same period. Look, 1600 hours to 1618, 1619. Do you see it? 1600 hours to 1619. Let's go back to the orders. Let's see what the order was telling us. 1600 hours to 1619. Buy, 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 buy into discounts below. Into discounts. In other words, be passive, be quiet, stay still. Let the price come to you. That's where you're going to get your value. Let the price drop down to your buy order. Do you think you've got the ability as a professional trader to read that and make that decision? Can you yourself right now look at that and say, I've got a fair idea what I'm doing here? You might not have a brilliant idea yet, but I'm pretty sure you can all agree with me that adding bids and futures bids and buy triggers and dispersion bidding into liquidity and adding bids, I'm pretty sure that even with a basic knowledge, you're going to be looking at that saying, I feel quite bullish. I hope anyway. And if you felt quite bullish and you were buying off the 15s during that entire process, you had one trade that made you a fair amount of money. That was already a $250 winner there before it scratched out. And then you added more liquidity. You got another buy off the 15s. It traded 29s. Same day, guys. It's not cherry picked. This is still yesterday. The timestamp here is showing you that this is still yesterday. This is now coming into 4 o'clock. The previous examples were all between 2 o'clock and 3 o'clock. This is us now at 4 o'clock. So we've only been in the market effectively for 1.5 hours, and we've had these 5 amazing trades. This trade was worth about $700 on its own. You can see that for yourself. A maximum of 700. We're not saying you're going to get that. If we total up those 5 trades, now there's more than 5 trades because you could have had the buy there and then a second buy trade on the retest, and you could have made some money on that. You could obviously be a multi-lot trader. We're not talking about that. We're talking about basically just the buy trades as far as the maximum swings. Have we shown you that as a maximum swing, you could have potentially have made $2,200 per contract over those 5 trades? There was a 500, a 250, a 250, a 500, and a 700. That doesn't include the extras. That doesn't include, for example, this winning trade here that scratched out. It basically just includes the bottom to top swing. Nobody's saying you'll top ticket. Nobody's saying you'll be the seller at the very top and the buyer at the very bottom. Nobody's claiming that. What we're saying is, would that have given you an edge? And is this the first time you've ever had that sort of edge, a professional edge in the markets? An ability to read that and say, I agree with it. An ability to look at it and say, that makes sense. An ability to recognize how this is playing out. For the first time, you've got the ability to not rely on somebody else. You might be saying, but surely we're relying on the trade log. Surely we're relying on that message. Well, as an intern, you're relying on this message. But by the end of the class, you're now interacting with this message. When you turn into a professional, you can look at that and say, I don't care. I don't care. I don't like it. I think there's something else going to happen here. As you evolve as a trader into a professional trader, it doesn't matter whether this dispersion guy phones your desk and says, listen, mate, I want to sell some business here. I want to buy some business. And it's the option dispersion guys. It's the guys you know that trade on the dispersion desks and the volatility markets. And they're saying, I want to sell some S&P. I want to buy some S&P. You can still sell them to the trade. You can still buy the trade. Or you can say, you know what, I'm going to take the other side of that deal because I don't like it one little bit. But what I'm saying at the beginning was, until you've got to that point, Your job as an intern is to start learning what these guys are doing. Your job is to recognize that these guys make a lot of good decisions. And therefore, worst case scenario is you do what they tell you to do and go with the trade. The market makers might be adding bids. It doesn't mean they're going to be right. But at the moment, we know they're at least adding bids. Did you know that before? Did you have that information before you started in the classroom? That on this occasion, they're adding bids at the bottom edge. Well, you do now. Can you live without that information? No. You must have it. You must know that they're adding the bid there. You must know, and this tells you they're adding the bid, allowing you to then say, okay, the market maker is adding bids here. What am I going to do about it? Do I care? At least we acknowledge that it's there. Should we want to sell, we don't sell to the market maker that's just added a bid. We sell perhaps a lot higher up if we're very, very bearish the market. Okay, so that's the S&P. I don't trade the S&P. I trade the commodities. Okay, so let's take a look and see whether you could have made any money on the commodities. Oh, we've got a trade number 6, guys. My God, it keeps going. You'll say, my God, keep going, Gary. Keep going. Trade number 6. We're now at 1700 hours. Let's take a look anyway, since it's there. The market maker added offers. Okay, so now we're getting the opposite of trade 5. So we can now get an idea that this is the opposite trade from trade 5's trade. It's the same day. It's not that long afterwards. You can see that this trade was at 1600 hours and this trade is now at 1700 hours. And the market maker has now started to add offers into premiums. The dealers are now rotating offers at swing highs. We're now getting dispersion sellers coming onto the phone asking you to sell the S&P. We're getting another dispersion seller on the phone asking you to sell the S&P. We're getting another dispersion hedger selling, asking you to sell the S&P. If you don't know anything better at this stage, you would say, well, they're obviously very short, so I'm going to be very short as you learn your profession, as you learn to be a professional trader. These guys are short, I'm going to be short. In other words, you're getting that insight, you're getting that heads up that somebody's on the phone, an informed trader is on the phone asking you to sell the S&P for them. And you're saying, well, I'm a prop trader, so knowing that is quite useful for me. I might be able to take advantage of that knowledge. I can also see that the market makers are adding a bit of sell-side liquidity above me. I like my chances here, and I don't have any evidence otherwise. So you know what? I'm going to go with the trade. I'm going to go with the phone call. Trade number 6. Did it make you a killing? Well, you can see where trade number 5 went to. Trade number 6, did it make you a killing? Check the time, guys, 17:15. So this is 17:16, 17:17, 17:18, right? It's a 1 minute chart. So 17:16, 17:17, 17:18, do we agree that that's those phone calls? Can we be 100% agreement that that's those phone calls? And if it was those phone calls, would it have been nearly impossible for you to lose money by following those traders? Well, you might argue, but what was my target? What was my out? What was my whatever? Well, I'm sure you could have figured something out that would have given you some money out of a 5-point move, right? A $250 profit, which takes you up to which actually takes you up to $2,450 profit per contract, maximum swing. And when the price retests here, you would be able to look at the phone and see if they're phoning again for more business. When you start graduating as a professional, you don't have to take their order and position yourself accordingly. You can trade against them. You can start making the decision. But if these guys get it right more often than they get it wrong, is this not the best information you've ever seen? These guys are on the phone to you guys. You're on the floor of the exchange or you're on the phone of an order book, and these guys are phoning you up saying, I want you to sell me some S&P. And you're saying, sold. Sure, it's 29. And at the same time as you're saying sell, you're saying, I'm going to sell some 29s as well. I'll take some at 29 as well. That guy sold 10. I'm going to sell one. I'm going to add to that position. I'm going to get some short against that. The phone calls came in. You're not having to figure out whether the phone call came in. It's on your message board here. It's on the trade log live in front of you in the classroom every day. Well, it will be when we get started in the classroom. At the moment, we're teaching this at the moment because this is just a new thing that we're bringing out. These are the phone calls that the professionals get every day. These are the phone calls that tell you what these guys want to do. If you've ever wanted to be on a professional desk, that's why we developed this. At this stage, you're an order taker. When you start the program, you're looking at their order and you're saying, this guy's a seller, this guy's a seller, this guy's a seller. This guy is adding offers. They want you to sell at higher prices. So you sell at higher prices for them. And as you go through the course, you start deciding whether you want to join them or whether you want to take the other side of the book. In other words, you become the broker, if you like, but you become the dealer broker. You have the ability to join them. So they sell, you sell. They sell, you buy. When you're an intern, you don't have that choice. They sell, you sell, and that's the rule because you're prop. If they're selling, I want to be selling. You're on the floor of the exchange and the dispersion guys that you know of start selling the S&P. You see their hands going up. You say, well, what are they selling at? 25 offered. I'll take 24.75. I'll go 4 3/4 offered. And you're stepping in front of them by one tick because they're selling. And then suddenly you say, that guy never worked. That trade never worked for me. I'm going to have to be careful about following these guys in the future because I'm not sure about that trade. And then you start learning. Okay, so I'm hoping that's the end of the S&P trades for yesterday. What we might be able to do now is take a look at a commodity trade. No, we've got one more. Oh my God, guys. Oh, will it ever finish? S&P, maximum offer. See how this is our strongest trade? 1823. So in other words, this is another big, this is like, just call this guy Max, okay? So when Max is on the phone, Max has just phoned you up at 1823 last night and said, sell me the S&P. Right now, sell me the S&P. And Max is coming in at 1823. Sell me the S&P, work me some orders, and you're at 34, 35, 36s. And you're saying, okay, I'm now getting that short sell. You know Max gets this trade right more often than not, right? And that trade went 38s down to 0.8s, guys. $1,500. Look at the time on the chart. It's yesterday again, isn't it? It's not made up stuff from 5 weeks ago. Do you realize that the trades we've just looked at have now tallied up to just under $4,000 per contract following those signals? Was there more signals? Well, we teach you that, of course. We don't take individual signals unless they're max signals. We group the signals together into areas. So if we get a bid, that's not enough for us to go buy side. We wait for the second bid unless it's a max bid. We start learning this by understanding the process. But we start learning it from an order taker's point of view. This is Max. Max is asking you to work some sell side business for him. And you know that that's going to be a sell trade. You know that that's got a very high probability sell trade. 1823, 1835. So there's a 23 trade, and the 35 trade is in exactly the same place. And that trade made $1,500. Can you live without these phone calls? It's like having Liechtenstein back on your squawk box, isn't it? Do you remember Ben Liechtenstein back in the days of the floor squawk? And Ben's shouting across the squawk, there's paper sellers coming in. There's paper sellers coming in at 38s, 36 offered here at 38s, 36 now offered here, 36 traded. Here we go, guys. There's paper sellers coming back in again at 38s. Not a very good Ben Liechtenstein accent, but you get the basic idea. You're getting that information for the first time ever since the floor disappeared, ever since the squawk box dried up and went silent for the last time. You're now getting the phone calls that the guys behind the floor were picking up on. And it's not anybody that's just phoning, it's Max that's phoning. And everybody pays attention to Max because Max doesn't get these deals wrong very often. A very high expectancy of at least being able to get a profit out of it and a scratch. And on this occasion, a trade worth $1,500, almost straight line for the rest of the evening. A sensational outcome for Max on that trade. And then what about another trade? Well, guess what? I'm afraid to say this was also Max. Max wanted to buy here. Max put in a bid here. And guess what happened? The price never went anywhere. Max got it wrong, guys. Max got it wrong. Yes, Max can get it wrong as well. Did Max lose any money? Possibly. Did Max lose a lot of money? No. If Max held on, could he have got his money back? Yeah. So was Max a terrible trader? Well, you might think so. And in due course, you might have lost some money on that trade as well, right? You might have said, well, I bought it with Max because Max is good, and you know, I managed to get 2 ticks out of it. I managed to get 5 ticks out of it. In the case, actually, you managed to get 8 ticks out of it, and then you scratched out and it lost your money or whatever. It doesn't make any difference. They're not always going to be winners. But what we teach in due course is that whilst it might even be Max, you still have the ability to say, well, I don't care what Max is doing here. I think it's a stinking trade. I wouldn't be Max buying this, but Max is on the phone saying he wants to buy it, so I'm buying it for him. I'm just not taking the same trade as him anymore. So you're effectively filling the order for Max, but you're not joining the order as a prop trader. Okay, so we're finally getting to the end of this S&P for yesterday, right? There's a lot of stuff here. If we look at the next chart here, you'll see it's not the S&P. You'll see a lot of arrows. This is copper. Copper, this is copper. And this is the trade log for copper here. The entire trade log for the entire day. Copper premiums, 1330. Copper premiums at 1344. Copper premiums. Remember, these are sellers. You're picking up the phone on your trading desk from a copper seller, a commercial seller who wants you to sell for them into these areas at the top edge. You've got the ability to hedge this against gold if you want to. So in other words, if you want to start hedging or if you want to start spreading, then you've got the ability to do those. And obviously we teach how to do that as a process. But at this stage, you're an intern. So if you're an intern, you assume that these guys are correct and you go with the trades, right? So there's an offer, there's an offer, there's an offer. And then at 14.59, 15.14, 15.30, 15.45, there's a bid, there's a bid, there's a bid, there's a bid. And then at 17.14 and 17.30, there's an offer and there's an offer. This is the entire trade log for copper in one screenshot. And this is the trades you would have had based on that screenshot. This became a series of sell trades that ultimately managed to swing for 500. This became a series of commercial buy trades that managed to swing for 550 per contract. And this became a series of sell trades, which at the time of the screenshot traded $200 on the sell side. Now, if you were to follow the copper chart from that point onwards, you'll recognize that this sell trade actually ended up doing $600 to the downside. So into these areas, if you saw that information and you followed those trades, do you think you'd have had a fair chance of making money, yes or no? Do you think you could have potentially even made $500 on each of those trades, yes or no? Do you think you could have at least made $100 on each of those trades? Yes or no? And as a series of trades, could you have been confident that if your phone keeps ringing from a big commercial buyer into the bottom edge and they're saying, I want you to work me some bids, I want you to work me some bids, that you would have had the ability as an intern to work the bids for this commercial buyer? As an intern then that's starting to take advantage of those bids, of that inside information, you're saying, you know what, that guy wants to buy 10, I'll buy 1. The guy wants to buy another 20, I'll buy another 2. The guy wants to buy another 10, I'll buy another 1. Could you use that information for your own benefit for the first time in your trading career? To be able to use that inside information. We're not cherry picking it, guys. That's the entire copper trade log. That's it. Do they all make money? Well, of course, if you look at any one individual trade, that first trade made money and scratched. The second trade made money and scratched. The third trade made money and came back down but didn't scratch. And the fourth trade exploded. So like 1 trade out of 4 exploded. 2 trades out of 4 scratched. And 1 trade exploded as well. On this trade, the first trade possibly lost money. The second trade exploded and the third trade exploded. So 2 out of 3 trades made a lot of money. On this trade here, the first trade made money, maybe scratched. The second trade exploded. So basically like 4 or 5 or 6 of those trades exploded into profit. One of the trades probably lost money, and a few of the trades scratched out as well. So you get the idea that it's not about just the one trade, it's about the process. It's about building the process. The point I'm making is, are you starting to see the idea of building from the intern? What is the intern's part of this exercise? The intern's part of this exercise is for you to be placed on that desk and get those phone calls. And that's it. The intern's part of the process is for you to get that phone call from this big copper trader who is saying, sell me some copper between 1:30 and 2 o'clock. And this copper commercial is now on the phone to you live. It's a live phone call. Sell me some copper, do your best, give me a price. I want to know what price, and you're working on your ability to execute, not on the direction, but on the execution. Get me a price, I want you to sell me some copper, get me a price, you work on your execution. And you suddenly recognize this guy makes a fortune on your hard work. You start recognizing that that copper commercial made a killing on that short sell that you've now done for them. And you start saying, I want a piece of this. This inside information seems to be quite positive. This inside information seems to be quite a good positive expectancy. I want a piece of this. So instead of taking it just for the commercial, you start taking it for yourself. You start using this inside information for your own benefit. And sometimes you might disagree with this inside information. The more experienced you get, the more understanding you have of the markets, the more you have the ability to say, I don't care if they're buying it here, I'm not going to buy it. I think they're mad to buy it at this price. Plus the other idea is that this sell trade, remember this idea here? So this guy here selling, this guy making a phone call, this guy might be closing out a long position, right? The guy might not be net short. So when we understand that this guy might not be net short, then this might not be a sell trade in the first place. It might just be a profit take on the way up. But what are the clues that it's not a profit take? The clues are that they sell more at lower prices. The clues are that they buy more at lower prices. The clues are that they sell more at lower prices. Sorry, they buy more at higher prices and they sell more at lower prices. The clues are all over the place. And as you start developing an eye for a professional angle on this, you start deciding whether you agree with them or disagree with them. I don't think that's a very good trade. I think that's a profit-taking trade. I don't think they're getting net short here. But you didn't get the phone call before. How many of you are getting that phone call right now? How many of you are on that back desk right now? How many of you have got anywhere else you can go that's going to give you that phone call? How many of you can leave this room without joining us and receive that information from those copper buyers? How many of you can get that information from those bond spread traders? How many people can get that information from the oil desks? How many of you have access to that phone call that tells you what they're wanting to do? And as an intern, you follow that until you understand what they're doing. As an intern, you fill for them. As an intern, you execute for them. As an intern, you bet best at execution, not on direction, on execution. In other words, you act on their instructions. So when you're acting on their instructions, you're reacting to their information, aren't you? You are acting on what they're telling you to do. You're acting on it. You're improving your execution abilities. And in due course, you start learning why. Why is that guy selling at that price? Why would that guy be net short at that price instead of just a profit taker at that price? Why would they be doing size on copper at that point? Why would Max be on the phone wanting to buy the S&P here? Is Max closing a short position? Or is Max getting net long here? I don't know, because it's just a phone call. I'm not going to be asking him, because he's not going to tell us, right? He's not going to tell me if he's net long or if he's net short. He just wants your order filled, and that's it. He doesn't want to talk to you about it. So you as a trader have to develop those unknowns. You've got to be the guy that then starts looking into these unknowns here and saying, you know what, this is what I need to know. Is Max long and closing it, or is Max short net when he's selling at that price? And the professional figures this out. The professional figures out what Max's position actually is. And because a professional figures out what Max's position is, Max's phone call becomes even more powerful. Max's phone call becomes even more powerful because now Max is giving you the phone call, and you know that Max is buying to get net long. An incredible piece of information. Well, I hope you would agree that it's pretty incredible. Obviously, it's we're a little bit biased here, of course, as you would imagine. We're a little bit biased because obviously we've designed this to make this idea a reality, because it's never been done. It's never happened. It's never been something that people can look at and say, yes, that's exactly what I would have thought. Thanks very much. It's never been done before. So when we look at this as a process and we start understanding this process, we start to recognize that this is from the intern to the pro. You can follow every single one of these trades from the GRT log. You can follow every single one of these trades from the trade log as a phone call. You can look at this oil hedger selling at 21.15 and you can say, right, okay, so as a phone call, that's somebody coming in and saying, I want to sell some oil. It seems to be a one-off. So you say, okay, somebody's selling some oil as a one-off. Do I now agree with it? Well, all I need to do is get the short sale against that execution and then learn to see why they were selling it. Are they selling it to close off a long position, or are they selling it to get net short? If I can figure that out, I can make some real money. And as we start to look into those as types of trade ideas, if we start to then consider the idea behind it, and we start challenging that oil trade at 21.15s, you can see that they're now working that exact price. Now, you're not going to do any business at 21.15 anyway. At 21.15, the highest probability is that's a long trade that's now closing because the market's closed, right? All the volume's gone off it. So this is probably somebody that bought in here that's now closing that bit of position. Would you agree? So all of a sudden, you're starting to make decisions. All of a sudden, you're starting to recognize that there's something happening here that you actually have some knowledge of even just now. There's nobody want to get net short oil at this time of the day. What the hell are you talking about? Who would want to get net short oil? So that's probably somebody that's closing off a position. Would you agree with that? So we start understanding this as an opportunity. We start understanding this as a process. You know, when we start looking at trades like this here, for example, at 1820 and 1920, and we start looking at 1820, 1920, and we start asking, well, did the oil traders actually buy that, so that we understand that that sell made a bit of sense, right? And if we look at the oil trades on their own, and we can see that 1824, they decided to bid into this. And at 1829, they decided to bid into this. And at 1829, they became bid watch. In other words, they're asking you to work the bids. And at 1830, they're asking you to work some bids. And at 1834, they're asking you to work some bids. Well, if they're asking you to work some bids, was this your domain here? Was this the bid you were working at 1820, 1821, 1822, 1823, 1824? Was this your bid? Is that what you did for this oil client, this big commercial? And did that trade make $300 for that oil client? And did you as a trader start recognizing that this may be a commercial trade level, regardless of whether they want any more business or not? Did this trade level become a commercial trade level that you are now paying attention to in case they came back on the phone? Well, the interesting thing that you start to learn as a professional is it's not just whether the oil traders came on the phone there, but it's also whether the bond traders came on to do a bit of inflation hedging. Because if the bond traders start coming in and they're hedging against inflation, that might give you an idea that the oil trader that's at the bottom edge really is bullish, because the bond traders are bullish as well, and we would expect an upside response. That's not the job of an intern. That's not something that any intern would have any insight into, but that's what you would have an insight into when you reach the end of this class, when you reach the professional stage, where you're starting to make an interpretation of these phone calls. You're not just taking the phone call. You're understanding the phone call. You're disagreeing with the phone call. You're agreeing with the phone call. Think about the client response you're going to get. Think about the conversation that you're now having with the client now that you're the top of the desk, the professional on the desk. A big commercial oil trader comes on and says, I want to buy 5,000 contracts or 500 contracts or 50 contracts. And you say, well, they might say to you as the head of the desk, they might say to you, what's the market doing? Already, you want to buy some oil here, okay? So we're seeing a bit of sell pressure coming in. So I think we're going to get a better price in the next few minutes. You want to hold off for just a little few minutes. Or, look, I'll tell you what's happening. We're not getting any sellers. You want to buy 5,000, we're not getting any sellers. If I try and buy you 5,000 right now, we're going to slip a lot of price points here, possibly as much as 20, 30 price points. So what I'm going to do for you is I'm going to work some offers. I'm going to work some selling into this market. I'm going to try and encourage a little bit of selling off the record. Hush, hush, right? I want to try and encourage a little bit of selling so that I can get your 5,000 filled at lower prices. What it's going to mean for you is it's going to mean that we're going to have to take a bit of time to do it. It might take me the next half hour. Are you happy with that? And all of a sudden that client then comes back and says, do your best. Do your best. So you're now looking at the market and saying, right, I know what I've got to do. I've got to get a 5,000 contract filled, and I've got about half an hour to get it done. So you start manipulating the price. Now, I'm not saying you're actually therefore doing this, of course. What I'm saying is you're understanding that process. You're understanding the old-fashioned way of trading. You're understanding the conversation that the pros have. You're understanding that that phone call brings you onto that desk in a real-time environment. If we could have developed this into a ringing bell and a phone call that you had to answer, we would have. We probably could have, but it's a bit gimmicky, of course. But the point is, you're getting put onto the desk. You're getting asked for those orders, and you're making decisions. And because these still have positive expectancy, you've got the ability to follow them if you wish to follow them. But what's going to happen is if you decide to follow them and they have a positive expectancy, even as an intern, you can start making the best of these trades by getting great execution. Because you start adding order flow to your understanding, you start adding the X's, you start adding the big key price levels, you start adding stop runs, you start adding all of these other elements, you start adding stacking and offering, pulling on the limit order book, you start adding order flow to the overall picture, you start adding all of these elements, and you start making the right decision from an execution point of view. You let the commercials tell you what they want. Your job is to get them the best price. And in do so, what happens is you start getting the best price. You start becoming pristine in your execution so that when you start making your own decisions, you've already acquired the necessary skills to knock it out the park. Is there anywhere else, and I'll ask that question again, is there anywhere else that you're getting that information? Does anywhere else provide you with that first step insight? Is there anywhere else that's going to give you the ability to evolve from that order-taking desk to a professional desk in due course? Is there anywhere else that gives you the ability to figure out how to be a professional trader instead of simply following somebody else's rules and therefore being 100% dependent on their ability to call good trades? Do you want to have that for your trading career, or do you want something different? Do you want to take responsibility, in other words? Or do you want to pass that responsibility to somebody else and just hope that whoever you've passed that responsibility to makes a bloody good job of it? But that doesn't mean you're a trader. That doesn't mean you can enter the trading forums and talk to traders, real traders. That means you're basically an order taker that's filling somebody else's orders for them. We do that. You've just seen it. We did that in copper. You had 100% win rate on these bigger position trades. Max had a very, very near 100% win rate based on at least the first rotations. You can do that if that's what you want to do. But as you evolve, you'll find that you have a bigger impact on that trade yourself. You'll start to understand whether you want to or whether you don't want to. I've taken up enough of your time, guys. We've done just under 2 hours. We obviously had the trade log up for about 30 minutes before the class started, so a few of you got a chance to have a good look at it during the course of that session. This is what we're offering. We're offering you that phone call. We're offering you the ability to either execute against that phone call, but what we are offering is the ability to then start interacting with that phone call from the position of head of desk as a professional trader. We're offering you the ability to decide if you want to follow the trade or if you want to disregard the trade entirely, hedge out your exposure, or join them in that buy trade at the bottom edge, join them in that copper sell trade at the top edge. The execution becomes part of your massive edge that you start developing, because your first step as an intern is to perfect your execution. So you learn to read the tape, you'll learn to read the stories, you'll learn to read the lanes, you'll learn to read the order book stacking and pulling, so that your execution for your client is pristine and on point. From that point onwards, you then develop the skills to become a professional trader. There's nowhere else that this happens. Nowhere else takes you on that journey. Nowhere else gets you those phone calls. If you think you've got the ability to get those phone calls yourself, go for it. Take them. But this is the closest you'll get to getting that real phone call from that real commercial, taking a real trade in real time. And you can set an alarm that sounds awfully like a telephone on those things, by the way. There is an alarm that does go off if you want it to. It just drives me crazy, so I don't use it. But you get the idea, yeah? I'm going to pass you back to Kim. We're going to say thanks very much. This is our last webinar we'll probably do before we get started on this. If you think you can make money using this, we've already shown you an awful lot of screenshots from yesterday and some from today. We've shown you trades that have totaled out for, the S&P totaled out for $4,000 on one contract over the course of that day. The copper trade topped out for $1,000. You saw that for yourself, over $1,500 eventually per contract on the copper. If you think that that can make you money from those phone calls, and those phone calls alone, think about what it could make when you start having the ability to decide whether to take the phone call or to disregard it. I'll leave you that. I hope you decide to join us. We will put in as much effort as we possibly can. Everybody knows that the one thing we do in the classroom is we keep trying and we keep trying, and we do not try and leave anybody behind. We try our best, guys. That's all we can ever promise. We'll keep trying. Have a good one. Have a safe one. If you decide not to join us, I wish you all the very best in the journey that you do take, in whatever direction you go with, and whoever you decide to trust your trading to. But I just want to leave you with that one last point. Are they giving you the trade, or are you making the decision? If they're giving you the trade, then everything is on them. You might like that idea, but I don't. If you want to be a trader, you can't have the decision being made by somebody else, by some other system. You have to make that decision. You have to be responsible. You have to take responsibility, because the vast majority of retail traders do not. And that's the problem. You don't know when the system's broken, and because it's broken, you don't know how to fix it, because it's not your system. You need to be the system. Have a good one, guys. Have a safe one. If you join us when we get started, I look forward to helping you out. We're there as much as we can. Yes, we do shout and we do bawl and we do scream at times, but that's just part of being on a trading desk, guys. It's the reality. Have a good one. I'm going to pass you back to Kim. Hope you enjoyed today. I'm going to say adios, amigos, arrivederci. Auf Wiedersehen, sayonara. Tot sins, tak skadua, dos vidania. And spasibo, guys. Ciao for now.
Thank you so much, Ray. Excellent. That was that was on point, perfect. I think we have a bunch of questions to answer. I think there's a bunch of traders, or now people are saying, yes, I want to be a trader. Take me from intern to pro. I think that's perfection, right? Go ahead, and I'll be here to answer some questions. Get you guys started. I'm going to go ahead and put up a screen so that you guys we can give you some details. How about that? Hopefully that works. How good was that? I know everyone is super, super anxious to learn more, especially with let's see, trying to get this where it'll work. For some reason, it's not wanting to do that. Oh, sometimes you have to be smarter here than I was trying to open up on the wrong screen. How about that? But you guys expect that from me at this point. I mean, you'd be disappointed if I wasn't making some kind of a mess somewhere. All right. Hey, thanks, Gio. All right, guys, let's get to it. I'll answer any questions that you guys have. We've already been through. We are going to be starting 100-day. And where did that come from? You know, I was just thinking about, if we're getting better each and every day, why don't we get started with this intern to pro? I loved when Ray, back in July, we were looking at, developing out. He was finishing up things with the trade log. And when he was showing how, you could take a systematic approach, I thought, boy, this is going to help traders coming in, or traders that are struggling, or just wherever traders are, if they want to build that consistency and confidence. So I loved giving traders the ability to do that. So that's where this intern to pro came into play. And, with trading being game of its statistical probabilities, So if you're thinking about 100 days, getting 1% better each day, that doesn't mean you're going to make 100%. What it means is each day you're going to be looking at your process, your learning, and taking you from where you are and being able to measure that into each kind of section, from the beginning section, the middle, where then, sometimes in the middle it'll even feel messier there than when you get started, to towards the end where you're really being able to see, measure your progress, know what fits for you, who you want to be as a trader. So that's our plan. That's what we have, coming up over the next, through the end of the year. And what I'm offering is a fast action bonus. So for those of you that have been saying, hey, I want this, I want this, I want this, you do want to come in today, because I am going to give an extra month. And anybody that spent time with Ray, so think about, as you're finishing up in December, knowing that you're going to start the year off 2024 with another month of Ray, of refining, sharpening your edges, and really building on that progress, so that 2024 can be your year in the markets. We have been and Ray will be continuing to do the trade log orientation. So the great thing is, if you come in today, let's say you say, you know what, I'm in, I want extra time, I want the trading tools, which I'm going to talk about, the order flow and the trading view, as well as things with the trade log. We do have on demand. Ray did a great session, an orientation, an introduction to the trade log. He's been adding to those over the last a couple weeks, so that traders can get familiar with those, and be able to make progress. So that's what we're going to do with that. We do have, and I really want to bring this up, because as Ray was showing you with the log, why did he develop that? Because he really wants traders to have access to the same type of resources and tools and insight that they have on the institutional desk. You can't get that, to get some of the information you could get if you're spending about $3,500 a month for a Bloomberg terminal, or if you're working on a desk, or you're paying, high, but that's outside the budget for most retail traders. So Ray and his team over the years have really thought about how can we bring these tools, because it's a challenge. Ray has really found being able to even develop these tools to be able to bring it to the retail space has been very, very challenging. And those traders that have been in our group know he's been working on some of this stuff for years. And, he's had to tweak it and scrap it, and tweak it and scrap it to, because of the different challenges. But to be able to give you real time, no lag, like he said, it's like you're getting a phone call from the pit saying, hey, hello, what do you want to do here? So that's where the trade log comes in. It will be showing it. It will be streaming in the room. And then it will also be available through, users. Once he has everybody trained, he wants people using it properly, not trying to follow it blindly and then saying this doesn't work. So we have our um, trade, our order flow suite that David built on Sierra Charts and on Ninja. It's a great way to get you started for, getting those execution for scalping tools. So you have that. And then we have which you saw there, where Ray was saying, hey, if this is red or this is blue, that's your big board RGL sentiment with aggregate volume tool, which is, I love it. It's, such a nice visual for those of you that are visual, keeps you on that right side. So think about, you have proper training. Ray's live in the room. He comes in during London, puts up his charts, and, puts up his charts, provides commentary as his schedule, permits. And then, we're going to roll into the US session, then we roll into class each and every day. So you're going to have, it's like being on a real institutional desk. You've got 5 to 7 hours of being able to be immersed in the markets. Think about over 100-day period, what that's going to do. Some of you work. We record all the classes. You can go back through them, but I highly recommend being able to get on your charts, take the lessons, do that. It's something we encourage each and every day. Let's see. Louis, I will get to, and I'll answer some of your questions. Guys, I wanted to just first go through and kind of let you know exactly what it's going to be. And then I'll go and answer all the questions because there is a lot. So just want to make sure. But you do get early bird access to all the resources. We do have an amazing, library for you to access, that you can get started. We have a quick start series with the Intern to Pro, and the scalping series is in there. The introduction to the trade log is in there. Like I was saying, the scalping secret series is in there to help you get started. We're going to be holding some trade lab blueprint sessions to help you with the different tools and the resources that we have, along with the institutional trade log training that Ray will be providing. You've got your tools for order flow and on TradingView. And then we have an amazing self-help group, one for that's a general that the traders put together. They help each other. And then we also have one for technical that helps traders on the tools. So that's super important. Thank you so much, Serge. I didn't even think about that. Serge is so good at helping and bringing you guys in the information. But you can see there's the link right there, compassfx.com/100 days. And that gets you know, get you going. And as we know, the secret to getting ahead is getting started. It's actually the hardest part, but we're, here for you. And I think that's kind of the key. I had one of the guys earlier that joined that came in during this early bird, and he said, that he's so happy, and he feels so good because he can really feel that we want him to have success. Because if traders reach out, I'm always happy to help you, take you where you are, help build out a plan, because every trader is different. And that's the thing that I feel that gets missed in this industry, is traders being able to recognize there's lots of ways to make money in the market. You've got to find what fits for you, the time you have available, your skill sets, the money, your emotional baggage. All of those good things have to come into play. And so sometimes you need that little extra. So this is not just a one size fits all. This is actually a program built around you to help you develop, to have that growth. And so that's what the plan is over this, through the end of the year and going into 2024. So hopefully that kind of gives you a good overview. I'm going to stop the recording and just answer questions for you guys, but you can book your ticket, compassfx.com/100 days. And also you can Skype me, Forex Kim, FOREXKIM. Email me, kim@compassfx.com, if you want to schedule a call. But make sure you get in and join us. That's going to be the important thing. Now let's answer a bunch of questions.